In the short term, markets are all about fear and greed and all about sentiment. So today I have with me Sandeep Tandon. He's a practitioner of fear and greed, and he firmly believes that in the market there are two elements which could drive extremes. One is fear and second is greed. US markets were trading at a greed level before the correction kicked in, but right now has fear kicked in. If you buy fear in the long term, you always make money. If you sell greed, in the short term you may underperform, but in the long term you will always save money. Is this time now to protect capital or time to get greedy? Sandeep, fantastic to have you back and thank you for joining us. I'll start with your first indicator, which is the Quant risk aversion indicator. What is this indicator? And when we say the Quant risk aversion indicator is at a 20-year high, what are you trying to indicate here?
So it's basically indicate the risk aversion which is happening at the global level. So it is more of a macro indicator rather than just stock market alone. It captures about the commodities movement, the precious metal, as well overall risk-related themes. So it's a combination we have tried to build, and it's a very good indicator. Gives you a classic tops and bottom, and particularly risk aversion when it's high, it's an indication that we are closer to a bottom.
When were we at high on this indicator last time?
So this is 2018 was another high,
okay.
And prior to that it was around 2016, Feb 2016, and 2008 obviously was one of the. But surprisingly, the pace global macro deteriorated in, let's say, in 7-8 trading session. That's the reason the spike is one of the highest.
In 2008, things got bad to worse.
Yeah.
But was the indicator predicted that post bear and Stanza Lehman was coming?
So we were one of the house who has predicted about bear phase resuming in August 2008, and we have been writing right from beginning 2018. It will be a difficult 2008, but turned out to be a disaster 2008. But if you look at the lot of data on the walls front, gives you a sense. We have been talking about how the volatility expansion phase which started in 2018 can go up to 2023. In our recent book also, we talked about 2020 will be one of the biggest wealth destruction phase globally. So we are in the elevated walls level. All asset class will remain very, very volatile. So you have to play or work out your strategy which is based on the high volatile environment.
Okay, so what you're saying is that your prop indicator is saying that we are at a 20-year high in terms of risk aversion, and every time if you bought stocks,
yeah,
you made money.
Yes.
Very simple analysis.
Yes.
It's too late to panic.
Yes.
But is it too early to buy?
So I will say, one has to look at not only from a near term, but also from a medium term perspective. So both from a near term perspective, we can say with huge amount of confidence, yes, it's opportunity. The market should bottom out in next 3-4 trading session, maybe by end of next week on higher side, globally market should bottom out. But what we have to watch, okay, particularly US market, developed market, where we have seen a euphoric phase, okay, so those market will become sell-on rallies, okay. We have seen extraordinary liquidity indicators for US and developed market is close to lifetime high. Okay, risk appetite is again close to lifetime high, and valuations are stretched. So we look at all three parameters in our VLT framework, which talks about valuation analytics, liquidity analytics, risk appetite analytics, and of course timing is also part of that. So euphoria has happened in US, which is not the case in India.
Okay. Your second indicator is that crude capitulation is at a 20-year high. Let's look at that graphic and then we'll talk about it. Crude is at an all-time high in terms of the capitulation.
Yes.
Isn't it too late to analyze crude now? Damage ho gaya?
See, you remember that we were there on 10th itself. We tried to cover that. That's the time live capitulation was happening when I told you, okay, this is opportunity to look at crude. And crude has appreciated nearly 25% from there. But from a longer term perspective, it gives you a sense that one important asset class has given you a big signs of weakness. And from a near term and medium term perspective, it is bottomed out. I expect crude to rally, okay, not on immediate basis, but I'm expecting that in next few months perspective, crude should move up further from these levels. Not very significantly, but it should move up.
In 2003 and between 2003 and 2010, crude and equity markets had a straight line, which is crude went on going higher, yeah. Equity markets, they kept on going higher. Can the reverse work right now when crude keeps on going lower, or crude has gone lower, equity markets will follow?
No, it will not work this time because market is very interesting. It keeps on evolving new correlation. Right now, the demand for different asset class, particularly alternative on the energy side, has come up. So it's not relevant. Actually, if you analyze the natural gas market has become more relevant in last few years as compared to crude. So I don't think this analogy will going to work anymore.
So you don't think a decline in crude is an indication of world folding up and world slowing down?
Up to small extent, answer is yes, but not necessary that this is the only indicator will gives you that.
Okay. The third indicator what we have is the Quant fear and greed indicator for India, which is what matters to our viewers eventually. The white line that tells you the spike.
Yes.
We saw a similar spike like this in 2018, 2015, and then 2008. We are not at 2008.
Yeah, we are nowhere close to that.
Okay, but are we close to 2018 and 15?
Yeah, both from February 2016 and September, October 2018, we are something that's closer to that level. So I expect maybe in next few trading session, maybe down the line 3-4 trading sessions. So it is very difficult to time it exactly, but we are there. Okay. So
why can't this be a high spike like 2008? Why do you think this will not be as bad as or as high as what we saw 10 years ago?
So there are a couple of reasons. In 2008 was a liquidity crisis. Okay, liquidity was suddenly frozen. Okay, and right now actually the reverse. In January, if I have to look at our liquidity indicator, was at lifetime high. Okay, which was more of a combination of a bad liquidity indicator, which is stimulus from the central bank, is one of the higher levels. So I don't think we are in that situation. So when you're talking about a massive liquidity there in the system, so liquidity indicator lifetime high, risk appetite which was significantly high in January, it has come off in last 2 months, okay, but still remains elevated as compared to what we have seen let's say in 2008 or so, okay. So with these two background, it looks unlikely that we are in 2008. You can't compare.
Okay, short built up, again market positioning, the short built up is saying that even though markets have fallen, the short positions have gone higher.
Yes.
So the bears right now feel that they don't need to cover, they feel markets are going to come down lower.
So key thing is that how to differentiate the short build up both from the strategic perspective as well as trading perspective. If these are strategic shorts, then it can remain elevated for some more time, but if these are tactical shorts position, then it will get covered up.
How does one figure out?
So that is not, to be candid with you, is not easy, but then we try to look at multiple other data points to feel something. My personal sense is that in this thing, strategic short positions are there in a big way, okay? So I don't think market will going to cut these positions in a hurry.
My question is very simple. I'm asking everybody else the same question, which is that when the crisis happened in 2008, when the world discovered a problem called subprime, if you got out, let's say in 2007, or beginning of 2008, you saved a lot of money. When there's a fire in the room and there is one exit door, if you get out first, you save because rest of the place will get burned down. Why do you think this is not 2008, where if you get out right now, you'll actually save? You know, everybody who's coming on the channel is making a case that you should buy. I'm asking a different question.
So let me put it this way. It's a very event specific, okay? If you recollect, let's say 2000, when US market peaked out, particularly NASDAQ peaked out, that was a very technology centric event. So there was a euphoria happened only in the technology stock or NASDAQ. There were no signs in Dow or S&P in any manner, okay? Something similar, it is a very event driven panic which has suddenly triggered, okay, which market was not prepared. The background is that there was extraordinary complacency in the market, liquidity indicator high, risk appetite high. That's the reason you are seeing a bigger impact. If you compare Lehman impact, right from October 2007, market has started correcting. So market has already corrected more than 25% by the time Lehman happened in US, okay? So that's the time people were not that level of complacency, and that's the reason the fall was happened, and then you have seen a rebound. This was like a shock. Okay, so it is sudden, which has happened. I think given the liquidity and the central bank working together will come back, but given the background, we believe this is a phase which can last for long. So I'm talking about not from the market correction point of view. As a strategy, we call it vol expansion phase, so volatility expansion phase. In this phase, your traditional styles or approaches will not work. Okay?
So how can one make money in this kind of a market?
So you have to be very agile in this environment. If you're getting opportunity, you should learn to book profits also.
Give me an example. What should one do right now?
So if you ask me from the immediate basis, I think it's opportunity to rebuild your exposure in next 3, 4, 5, 6 trading sessions, okay? With a clear intention that part of these holdings, whenever market gives you a sharp rebound down the line or 2 or 3 months.
What will you buy?
Okay, so I think I will go for stock specific thing rather than just buying the market as a whole. Okay, so pharma as a sector looks good to me, utilities as a sector looks good to me. Okay, these are the two themes which comes out with a lot of certainty and clarity.
Why
and
would
then
you
some
buy
of the
utilities?
consumption names also.
Why would you buy utilities?
See what happens if you, I look at a more from macro background. when global markets have peaked out, which was our call in the 2020, we'll remember, for the tougher global market, particularly DM and in US, okay. Some of the market has already peaked out in 2018, between 2018-19 also. So this is the when global market peaks or the money move toward the less risky assets, okay. And utility fits that bill irrespective of the market condition. Their earnings will not going to impact up to that extent. So it's a global phenomena which we have seen, okay. People will move toward defensive name. So pharma also qualify. So pharma utility qualifies in that.
Historically, when market panics have happened, IT and pharma outperform.
Yeah.
Will it be different this time?
So everything is a global phenomena? I don't think so. We are very constructive on global biotechnology stocks also. So with that background can be extended to pharma and healthcare also. And we have seen global pharma index, we have seen a euphoric move in 2015, and so is the case with India also. So pharma index peaked out from our euphoria point of view in 2015. It's largely capitulated in September, October of 2019, and and if you notice from September, October 2019, pharma actually has outperformed. Okay, not all stocks, but most of them.
If consumer stocks are expensive, why should they come back and outperform?
So again, what happens? It's all about the consumption theme, which will remain there, because if you given the looking the background, India good rabi crop, and given the expected another good monsoon, I think there's a space which is a part of necessity, and not every name. Some of the names which has corrected sharply. Those are the names one can look at these levels also, and there's a theme can continue.
Yes Bank was this hanging sword for markets. Nobody knew which way things were moving. Now we know that, the entire episode has been handled. What will this do to rest of the NBFCs and other banks? And if Yes Bank problem is solved, why the RBLs and Bandhan banks of the world are falling? They should be rising because there's a relief now.
I think obviously it's a good relief for the market, that news which people were expecting, that event is over, okay. But when one event gets over and there's some amount of fear gets in, and that is the case, something similar will happen to other banks, maybe the name which you mentioned. So I think it's a fear factor is much more. And people, and I don't want to disagree with that thing. If you have a worry, if you have a fear, I think let's prefer to move out from these names before price and walls are indicating, okay. If you look at some of the banks like Yes Bank, implied volatility has been very high for last many months. So is the case with RBL. This is a classic sign that which indicates something is not right. I cannot say what is wrong, but something is not right in these names.
Another space which has got completely capitulated, we haven't spoken about it, is metals. Vedanta is down from 180 to 100. JSW Steel is down by a good 25-30%. Is there a trade there?
So if global markets settle right, which is my view, by let's say next Friday on higher side, I'm saying very conservative thing, global market will settle down, global equity will settle down, and China.
Next Friday, that's 2 weeks away.
Next Friday is not very far away. Okay.
Sir, 10 दिन में बहुत गिर जाएगा.
So I'm saying the 80% damage is already been done. If I have to quantify in terms of panic levels, 80% panic has been factored in. It's last 20% which is left, which may or may not happen. Okay. So I will look for opportunity to buy these names actually, because two reasons. First of all, dollar has corrected a lot. Okay, so if you really look at the dollar index, which was also our call, the 1920 will be top for the dollar. Dollar has corrected and Asian currencies are not. Okay, where dollar index has fallen against developed market currency and ADXY has not deteriorated up to that extent. I'm remain slightly more constructive of emerging market currencies. Okay, and with that background, money flow will happen towards emerging market. If I have to say that theme EM versus DM, then in 2020 I will play a EM theme over DM themes. Okay, with that background, money will come to these markets and metals should rebound from these levels. So it's an opportunity to buy.
Closing question, take a breath. It's a tricky one.
Yeah.
If somebody says that, Sandeep, pour in your experience, your quant analysis, your market analysis, your proprietary analysis, your personal portfolio analysis, and if you have to make one trade where the volatility could be 20%, the downside could be 15%. But if somebody is able to digest that 15-20% volatility, it could be 25 on a bad day. But if somebody is looking at absolute returns for next 3 years, which is one trade you would like to do right now, today, as we speak?
So one trade for next 5 traders, if I have to average out, is only Nifty.
Okay.
So I'll buy Nifty instead of Bank Nifty. Bank Nifty has not
next 5
bottomed
days.
out. Next 3, 4, 5 days.
Okay, next 1 year.
So if you really look at, if you don't want to get used to this volatile environment, and market will be volatile, okay? So I will like to play in the Nifty as compared to individual names.
Okay, so 1 year and 5 days and 1 year Nifty.
Yeah.
Okay, 5 years now. One trade for next 5 years. It cannot be Nifty for 5 years.
No, it's to be candid with you, it's too premature to talk about 5 years. This is what we are talking about, that we are in the volatility expansion phase. So the traditional approach of buy and hold for 5 years, that approach will not work. So if we call it buy and hold, that era is over. Okay. So you have to manage your position in a more adaptive environment. So you have to work on adaptive asset
Buy the Nifty,
allocation.
not the bank Nifty. I just want to clear it.
Okay, two reasons. Bank Nifty, you have seen a Nifty capitulation happening few minutes back. There's no signs of Bank Nifty getting capitulated. So our behavior indicators are not indicating anything like that. That's one of the reasons. Second thing, bank stocks are grossly overowned. Everybody owns a bank, whether it's a local firm or global firms. So that's another indicator from a behavior point of view.
Okay, buy the Nifty and don't lose the faith. Appreciate your time. Thank you for joining us.
Thanks.
We've shaken hands, but the sanitizer is coming on its way. Thank you for joining us. For the moment, it's back to the studio.